tape number 6. And I'm a retired certified public accountant. I'm that author, those 2 books, Volume 1 and Volume 2, about banking. And this is to teach you how to teach your CPA how to become the expert witness. Because they can do things for you in court that you could never do for yourself. And remember, you're going into a military court that can make up whatever law they want at the time. But they don't want to be embarrassed. So that's why you need someone there to represent you and to say this, 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 this. And that way the other side needs an expert witness to come in against. Okay, so you want to embarrass that judge into doing what you want. And you want to make it easy for that judge to do as you ask. Okay, here's an example. Let's say you have a car dealer, and a CPA is auditing this car dealer, and this CPA found out that this car dealer is getting the inventory by stealing it. Can that CPA do an audit of that car dealer? No, he cannot. Because you have an illegal operation. Those people never agreed to have their car stolen from them. So that CPA should really turn them in. And the other thing is there's something illegal going on, but the continuing operation of this whole thing is in question. And for an audit, you have to say, well, gee, is this business going to stay in business, 3 years from now? Is there a going concern? Are they going to stay around? Because investors would want to know if this business is legitimate and going to stay around. You could have, an illegal operation. I used to do accounting. I used to have my own little accounting practice. And I had a guy who, I did accounting for him, and I don't remember the exact deal right now, but it had something to do with TVs and cable TV, and he had something you attach to it and you do something. And at that time, it was legal to do this. And he sold this through a magazine, and he had people calling him left or right. And I'd come into it, and he was making just tremendous amounts of money. And he would just be laughing about it. And this guy, before he did this, he was making like $6, $7 an hour as a forklift operator. And this goes back almost 10 years ago. And they passed a law so he couldn't sell this device for this cable thing to the general public. He could only wholesale it out to other people. And the FBI came and had a little chit-chat with him. Well, I was starting to question the legal operation of this business and doing the accounting, not even doing an audit, just plain doing the bookkeeping. And I finally asked him, I says, look, I'm going to teach you how to do your own bookkeeping. I think I want out of here. Okay? So that's how serious this thing is when you come to CPAs. I had to give him up. And this guy paid me, he wanted to give me money. And his questions to me were things like, well, Tom, I want to go buy a house. Should I pay cash or should I get a loan? These are the type of questions that he had with me. And he was just, 6, 12 months into operation, and he was making fists full of money. All right, let's go into this. We talk about the ethics. I want you to go to the state licensing for the CPAs. So call up a CPA and just ask them, say, I'm thinking about, learning about being a CPA, and who do I have to call about? Who's the licensing for CPAs? And they'll probably tell you who it is. It's probably the state capitol. And you can call them up and they'll probably tell you where it is. You want to get the ethics of a CPA in that state and the different requirements, because you're going to use that as ammunition against that person who did the bank audit, or if they're a certified public accountant. And number one, they cannot be involved in discreditable acts. That's like fraud. So they can't be involved in an accounting client that's involved in a fraudulent or illegal operation. How about independence? Now, the American Institute of Certified Public Accountants, they're trying to say, well, if there's no loan from that particular bank to the auditor of the bank that auditor's if that auditor's auditing that bank, then they're independent. Well, I say they can say that, but I think they're not really truly independent still, because they need those bank loans for their clients. They also have to use due professional care. Think about it. You're going into surgery, and here's a doctor, and He's not using due professional care. He's walking in and he's under drugs, and he's an alcoholic, and he's half drunk, and he doesn't know the latest procedures, and he's going to operate on you. He's not using due professional care. They also have to have competence to do the audit. They cannot take on an assignment unless they can believe they can finish it with due professional care and competence. They have to be professionally competent to complete it. So I think you can bring that up. And then I'm going to give you the minimum standards, and these are not the maximums. It comes right out in the audit book, and it blatantly says that even though we're going to show you how to do an audit, these may not be enough procedures to completely do an accurate audit. So just because these are minimums doesn't mean they shouldn't do more than this. So I go right through this in volume number 2 as well. But I talk about they have to have trained personnel. They have to be independent. That means a mental attitude of being independent. Do professional care. Work has to be planned and supervised. They have to evaluate the internal controls. That's like the bookkeeping entries. They have to do tests to investigate and confirm. That's like they have to ask people, do they really owe the bank the money? They have to use generally accepted accounting principles. That means a standard bookkeeping entries that the Federal Reserve Bank talks about. They have to be consistently applied. The financial statements has to have like footnotes to explain what those numbers mean. And then they have to render an opinion. And they have to say, well, gee, we think the financial statements are correct or they're incorrect, one or the other. And I don't want to get into all the different type of audit opinions and things like this. As we're talking about audit opinions, many times people incorrectly come up to a CPA and says, would you give me your opinion? As I understand it, a CPA can only give an opinion of those financial statements. So if you're working with your lawyer and your CPA, do not have the lawyer on the witness stand ask your CPA who's on the witness stand. What I mean is your lawyer ask your CPA on the witness stand, what is your professional opinion? He did not do an audit. So you can ask the CPA, what is your belief? According to your investigation, what did you find? And that's the way to approach that CPA on the witness stand. Don't ask them, what is your opinion? Because that means they did an audit. That's the type of game you play against the other expert witness who's a CPA. Okay, let's go on. Why an audit? Why do you do an audit? You do an audit so the users of those financial statements, those people who rely on those financial statements for investing or loaning money to the company or buying stocks or whatever, know that those financial statements are something that they can rely upon as far as investing money. Now what happens is, many times in the old days, they used to put those audit reports out in the bank lobby so they can boast that we had this CPA firm do an audit and we're doing everything correctly. When I told these bankers and the CPAs, I'm going to show people how to go about suing you, and I'm going to rise up a whole nation against this so we can get it corrected, all of a sudden those audit reports and those financial statements of those banks disappeared. We go back a year later and say, can you give us an audit? No, we're not going to give you that audit report. Because those CPAs told those bankers, do not give those things out to the general population because we don't want them to sue us. And that was the reason for it. Okay, now let's talk about the legal liability. In May of 1997, I was in an airplane flying from Tucson to San Diego. We're holding a secret meeting there in San Diego of some of the top business people in the country that wanted to help me. Very secretive meeting, so there's a lot of people behind us, folks. But when I was in that meeting, I was in an airplane, I sat next to an underwriter who underwrites insurance for professionals. And what she told me was, she said, you know, they almost settle each and every case out of court. And their standard for a quick settlement is about $10,000. Now, can you imagine that? Most all the CPAs have professional insurance. They're paying $500 to $1,000 a month in professional insurance because they're so afraid they're going to get sued. Later on, I'm going to be showing you guys, the ones that stick with me or are loyal with me, I'm going to show you something else to go after these CPAs on some other issue, which I'm not going to talk about right now, and you're going to be really happy, I think. So just stick with me on all this, all right? I need loyal people out there, because once you understand this banking thing, I'm going to show them something else that has to do with banking and a banking agent that's taking money from the average American taxpayer. And I'm going to show you how to go after those CPAs in the future. And I'm going to probably even do it for free. I'm so mad at the CPAs. I'm just not going to tell you right now, because those people try to take information from me. They try to go out and they want to show everybody else how to do something by stealing information from me. They're just going to have to wait. All right, let's go on. A liability. See, the CPAs have a liability to the client, to third parties, and they also have a criminal liability. Now let's talk about a liability to the clients. If the CPA breached the contract with the client, then they have negligence. And the client thinks the CPA is out there to find fraud. Let's talk about this. Is a CPA in a bank audit there to find fraud? Not really. There's two different types of audit. You can go out and have one type of investigation just looking for the fraud. The other one is you just want to make sure the financial statements are materially correct. Now, if the CPA clearly does not follow generally accepted auditing standards, and they would have found the fraud if they did follow generally accepted auditing standards, then the CPA is guilty. It's time to wake up. This is the key thing right here. So guys, wake up. I'm going to repeat this. I used to teach people how to fly. Before you take off and before you land, there's a checklist to make sure that you're going to go through things. It's like, make sure that you have your fuel turned to the tank with the most gas in it. You make sure your fuel pump is on if you're in a Piper or Beechcraft. If you're in Cessna, you have to pull out the carburetor heat. You got to make sure your wheels are down, your mixture is rich, your prop is turned the right way. So you go through a checklist before you take off and before you land. Same way with a CPA doing a bank audit. There's a checklist. There's certain things he has to investigate and he has to do. And if he doesn't do those things, he is guilty if he doesn't find the fraud. If he would have found fraud, if he went through that checklist. I am here now to show you that checklist that I believe if the CPA went through that checklist, that they would have found the fraud. That's what I truly believe. And a lot of those questions that I don't have time to go through on this are in volume number 2. Because see, I like it going after that CPA bank auditor, because they cannot come back and say, I don't know the answer to the question. See, a banker, their defense is, I don't know. You want their expert on the witness stand. You want their auditor, bank auditor, because they have, by taking on that assignment, they said that they were competent, they knew this information, they understood the policies and procedures, they knew the bookkeeping entries, they knew the bank fulfilled the bank loan agreement, so they got to explain all of this. They can't get out of it now. That's why I want this whole thing to center around the CPA. See, in the beginning, I wanted to go after the CPA and use that as a basis to go after the bank, and that was the best way to go after them. And then they hurried up and immediately passed a law saying that making it really, really difficult to go after the CPA. So now instead of going after the CPA first, you have to go after the guy who has the promissory note first, and then you back into the CPA. Let's go on. They have a liability to third parties. That means those who rely on the financial statements, the CPA knew that you relied on the financial statements and that you have a loss. So if there's a $100,000 loan, you haven't automatically lost $100,000 of your future wages. That's why you're in perpetual debt. Now, to make the CPA liable, you need 3 things. Number 1, you need misleading financial statements. You got that. At least I think you do. You lost money, you got that, and then you relied on the financial statements that caused the loss. They don't know if you relied on those financial statements. You know that every CPA, that every bank out there gets audited by a certified public accountant. And the bank could not remain in operation if the CPA knew that they were insolvent, if they were in violation of the law, if they're breaching agreements. So you had a confidence knowing this, and you could have asked for the audit report, and if you're really nice and use a lot of honey and says, I might want to be a major depositor here, and I want to make sure your bank is on the up and up, and we look at your financial statements, your audit report. Now they're really trying to hide them. But at one time, it wasn't too hard to find them. So as long as you're making the statements, you don't have to remember who they are. You're just a guy off the street. You read it. There was a CPA. Okay, you didn't keep it. You said, okay, everything's fine, no problem. And now you find out they knowingly did this to you. So now you want to go back and have a chit-chat with them. Really, there's about 6 big CPA firms, and most of those and there's certain one of those doing bank audits like Cooper's Lybrand, Pete Marwick and Mitchell. Those type are doing bank audits. They've been notified. They've been told. They know. So they can't say they were not noticed. Okay, and then you should be writing to these CPA firms, giving them notice, just everybody doing this, registered mail return receipt, and they just remain silent. Write to the legal department one letter, and to the partners the other letter. Same letter. Okay, fraud is willful misstatement or omission of material fact with intent to deceive. Did they omit something? Yes. I write out of the agreement about the unauthorized loan from you to them. Advertising or agreement or omitting and stealing from you. Now, they want to keep quiet about how did they get something of value from you to them and they got it for free. How did they get that done? They're going to say, well, we created money. We loaned it to you. That bank liability has no value without legal tender behind it. And where did they get the legal tender? They got it from you because they got your promissory note for free, and they had to sell the promissory note, and they used that asset to purchase the legal tender to make their newly created alleged money have value. So the whole value from this whole transaction came from you and your labor. The CPA knew this. He had to have known it because remember how we went back and earlier in these tapes, we talked about the accounting principles of matching. And if I showed you the bookkeeping entries, you have to tell me what the contract is. And that's why we have all these questions back here to prove up exactly what we're saying. Excuse me. So I believe that the generally accepted accounting principles, the standard bookkeeping entries, did not reflect what was in the written agreement. Now we're going to talk about criminal liability. Under criminal liability, the CPA and the banker could be criminally liable for filing false financial statements, for mail fraud because it went through the mail. The bank invoiced you for the loan, so you got mail fraud right there, and wiretap because they called you on the telephone. Now, a criminal offense to defend anyone, a criminal offense to defraud anyone by knowingly being involved in false financial statements. When they did this audit, they knew what was going on. They had to, or they didn't have the competence, but still you can get them under gross fraud or gross negligence. To defend this, they must explain the bank loan agreement, and they got it for free without making a loan that they promised. They changed the cost and changed the risk, causing you to be damaged. They have to explain why the government now is not under the Constitution, gold and silver. They have to explain all the other agreements that maybe have been entered into other than this bank loan agreement. They have to explain the United States is bankrupt as a nation and the banks are the creditors, and how the banks became the creditors because the lawmakers and the judges and the police refused to uphold the United States Constitution. So we fought the Revolutionary War to stop the very current banking system we're under, and they got it turned around. So we want to know how they got this thing turned around, because the CPA has to take a look at the law. in the contract. So he has to know all this. I say there's very high probability they don't know this. They don't understand it like I understand it, because I specialize in this. The CPA must maintain the confidence of the public, and it is the public trust that they're there to maintain. See, the CPA is like the policeman. He's like a policeman, a detector. He goes in and takes a look at those financial statements to make sure that everything is on the up and up, there to protect the public. He's not there. See, a lot of people think lawmakers are there because people voted them in. Lawmakers are there for big business to pass laws to take from your pocket and give to big business. That's what the lawmakers are there for. The judges are there for to try and stop you from winning in court against the bank, because they're there to uphold a national bankruptcy. But they got to have the appearance of making it look like they're honest and just and they're under the Constitution, because they know if everybody understood what was really going on, they'd be out of office. Let's take a look at the ethics. That's where you want to call up the state licensing for the CPAs to get those ethics. But I'm going to tell you right now, they have to be independent. They have to have integrity. In other words, the CPA cannot omit the truth. They have to have objectivity. This must mean the CPA must maintain impartial attitude on all matters. If that's the case, and if they ever record a promissory note as a loan from this person to the bank, would the promissory note be recorded as a bank asset with a new bank liability? The answer is yes. So under that objectivity, they have to agree that there was a loan from you to the bank. And we know the loan back from the bank back to you is when they wrote a check and they transferred that liability from your checking account to someone else's checking account. They never paid the liability. The CPA knows they never paid the debt. They got a problem with their objectivity under the audit. Also, competence. They have to have the competence to understand what I'm talking about. If they don't, they have a problem. That means they can't even do the audit. They have to have responsibility to the client and other responsibilities. And other responsibilities mean this: a keen consciousness of the public interest and the needs of society. I don't think we need to be lied to or stolen from. And they don't keep the United States Constitution, obviously. So we get to enter that into as evidence against them. Let's take a look at the ethics, the responsibility to colleagues. Under this audit book, it explains that if you're a CPA and you find another CPA that's doing something wrong, the CPA that found out about the fraud must expose it. So that's what I'm doing right now. I am exposing it. And I have to look at the welfare of the public should be the guide to the members' actions. So if I'm a member of all these CPAs, or somebody else is, you must take a look at the public and the guide to look at the public welfare. And my actions have to be there to help the public welfare, not the CPA that defrauded the public. So I'm simply doing what the textbook tells me to do. And I have to bring this out here on a cassette tape simply because if they ever come back at me legally, or a judge does, I want to use this as my defense. Next page, they go on and they say, again, the book for a second time explains that a CPA is not responsible to detect fraud if the CPA followed generally accepted auditing standards. Now, if the CPA followed generally accepted auditing standards, they have to know the policies and procedures of the Federal Reserve Bank. They have to know the standard bank bookkeeping entries, and they also have to take a look at the ratios of the assets and liabilities keep on increasing. That means there was an exchange. And they omitted the part about the loan from you to the bank under the agreement. The CPA must consider the likelihood of a client becoming bankrupt. See, my question is, if they paid all this money that they owe, guess what? They'd be bankrupt, wouldn't they? Now the bank's going to come back and they're going to say, yeah, but we use U.S. currency. That's what people accept as money. Well, do banks accept checks as money? If they deposit, yes, they do. Do they accept cash as money? Yes, they do. Do they accept promissory notes as money? Yes, they do. Yes, they do. So that means promissory notes are U.S. currency. The substitute for that is the bank liability that acts like money, but it is not money. It cannot even be paid without the asset. So a check can act like money, presuming there's funds on deposit to make the check valid. The bank has to come back and say, but we put money into your checking account. That's the bank demand deposit account. They credited your checking account. They can't credit your checking account without what? Having a bank asset behind it. So that and the proof of that is the assets and liabilities have to match. They have to balance. So they're going to play that game. They're going to say, but we credited your checking account. Fine, you credited my checking account. You increased the bank liabilities. You can't do that without a new asset. The bank's own publications state how you deposit cash, you deposit checks. That's an asset. That means your liability increases at the bank. That means they credit your checking account. So we're saying if you can deposit cash, that's an asset. They want to come back and say a deposit means you increase your checking account balance. That's true. But what I'm saying is you can't have a deposit without assets and liabilities both increasing. The new asset, new liability represent the same funds deposited to issue that check. And that's where they fall down. Because they have to separate the liability and the asset, and they have to say the cash is no longer the money, the new bank liability is the money. We know that cash is cash. This remains legal tender. If the bank paid the unauthorized loans to the banks, would the banks become bankrupt? I believe the answer is yes. If yes, would it affect your CPA audit opinion? The answer is yes. If they paid those, that means they haven't paid them yet. That means they haven't paid the borrower. Remember, they changed the whole agreement and they made you the depositor. So they owe you for the deposit. They owe you for the money that they said they're going to loan you. They only paid you once. They owe you one more time. And the proof of that is there's a liability with your name on it saying they still owe you the money. And the auditor has to have known this. All right, I want you to act sophisticated when you talk to these CPAs. And so I want you to talk their language. So this is it. You're going to talk about intentional versus unintentional errors. And I'm going to be bringing this up for the next hour or two. Combined errors are more important to consider than individual errors. So if they're making combined errors as to granting these alleged loans and ignoring the loan from you to the bank, that would be a combined error. Tremendous error as far as I see it. So the CPA must look at the material effects of the financial statements. And if a competent, independent jury decides the bank defrauded the alleged borrower, then I think we have them close to under 30 felonies, 25 or 30 felonies. And I'm saying if we got to explain all this to an independent jury without any judge interfering in... See, what happens is a judge tries to interfere with that jury, and the judge tries to say, well, and the judge is going to try to make that jury walk out of the room while we present evidence. Then the judge says, well, you can't talk about that, and then have the jury come back in and not allow the jury to hear certain evidence. And that's how a judge tries to force... See, juries don't understand that they can start asking questions of people on the witness stand. They can say, we want to hear everything that you have not allowed us to hear because we want to weigh the evidence. And they get to judge the law as well. So a jury gets to judge the law and says, I don't care what they passed here. They can't go around defrauding us here on the jury with our bank loans. You understand what I'm saying? I want a jury to have to hear this. I want a judge, if they're going to put these cassette tapes on the witness stand at any time, I want the judge to say, we got to delete certain information from here. No, we're not going to let them delete that. Also, they get to read the jury rights in volume number 1. because that is part of the information that I have that I would want a jury to hear. Okay, let's go on. Also, remember, these cassette tapes they're trademarked, a trade secret. That means you cannot listen to them unless you sign an agreement with us and paid us the money. You cannot resell these tapes to the general public. Also, these cassette tapes are copyrighted. Tom Schaaf, 1997. You may not make copies. We're trying to use these tapes and books to raise the funds we need to get this country turned around. And we're asking for your help and cooperation. So if a friend of yours comes to you and says, hey, would you make a copy? Just say no. I'm in an agreement. I have to keep my word. Because what happens is if you make a copy and we find out about it, you're out of the club. You're out. You're on your own. And we're putting out a reward for individuals finding anybody making copies of these cassette tapes. And it has worked. We have found people have made copies. We've kicked them out of the clubs. One person actually went to jail. They needed my help to stay out of jail. I wouldn't help them. And they got themselves into a lot of trouble. So you need me later. You're going to need me later, so we're asking you not to violate these agreements. Please. If somebody made a copy and they gave you this, and you need to get back to me, let me know, because there's a reward out there. So you want the reward, okay? Let's go on. In this audit book, the CPA must consider the client's lack of basic integrity and the management may or will breach agreements or mislead or use false financial statements. First of all, the CPA has to go back and say, are they following the United States Constitution? Obviously not. I think that shows a breach of integrity, and they do not record the loan from you to the bank. They don't discuss it. I think that also shows a lack of integrity and false financial statements, because if that bank had to repay those loans, they could be out of business. A CPA also would have to know that for going concern. And so this CPA has one big problem. Now also, you be the judge and jury. Let's say if you're a manufacturing company and someone's auditing this and you're manufacturing for the government and there's a contract, and let's say this manufacturing company didn't manufacture according to the specifications that the government wanted, and they were grossly not meeting those specifications. And this company was subject to having to go back and remanufacture all this. That CPA would have to consider the cost of the overruns and cost of redoing all this and the effect on the financial statements. And if the manufacturing company is going to stay in business or not. Well, the same thing would have to hold with the bank. See if there's a breach of agreement and the cost and all this. So I think they have one tremendous problem as far as a breach of an agreement. I'm going on in this audit book so you know enough information you can talk to these CPAs. It goes on, and in this particular book it says there's minimum standards. It shows the generally accepted auditing standards as GAAS are the minimum standards. And it says the minimum standards are insufficient for most audits. That is one of the key things. So if you're asleep, and go back and re-listen to this. It says, the audit book says that the generally accepted auditing standards are minimum. The minimum standards are insufficient for most audits. So this is where you're going to nail that bank auditor. It explains that the CPA must use professional judgment. They should not a CPA know about my books and cassette tapes that I have out there? How about all the free tapes that you can, this you cannot copy, but I do have a 60-minute cassette tape you can copy and give it out to other people. They should know about this. We've written to the CPAs. They've been told. They know. It explains that the CPA auditors Must also know the bank policies and the contracts, the bookkeeping entries, and the client's industry. They know all this. They have to know it if they do the audit. And I think they have failed. And when performing an audit, also you want to take a sample size. They don't look at every single bookkeeping entries. They just take a sample size. They have to read the bank loan agreement. They have to go back and take a look at the bookkeeping entries to see if it correlated to the bookkeeping entries. They can't just say, well, they got a check. They have to take a look at the bookkeeping entries. Who funded the check? The CPA must know the bank policies, internal control, that means the bookkeeping entries. They have to take a look at the analytical tests, that's the ratios. That means the assets and liabilities increased. Well, how can you have assets and liabilities increase and them not know that it was the borrower who funded the check? We already went over the Uniform Commercial Code talking about this. Now, if every CPA firm is in error, then you have to compare the ratios. What happens is other CPAs doing an audit, they're taking a look at their bank and the ratios of the balance sheet, this liability to, cash, or the expenses and the income. They look at the ratios. They compare it to the whole industry. But if the whole industry is off because they're in violation of the agreement, then you're talking about RICO, white-collar crime. And I'm just asking you, is it white-collar crime? Is it RICO? You be the judge and you be the jury. I'm not saying it's a fraud. You make your own decision. I'm just trying to lead you down the path of knowledge of what a CPA has to know to do a bank audit. Now, the same audit book, it goes in and it talks about the clients have to take a look at the legal obligations. In other words, the CPA must review the bank loan agreements to see if the bank breached or fulfilled it. Isn't this neat? Once you get that CPA in that witness stand and you get them to tell the whole truth and nothing but the truth, and keep on that, the truth and nothing but the truth. Is this the whole truth and nothing but the truth? You keep on hitting them on that because they just want to talk about part truths. They don't want to talk about whole truth. And the bookkeeping entries are clear-cut. There isn't any ifs, ands, or buts. There isn't any gray area like in business valuation. This is why I like teaching you about the bookkeeping entries, because it's great. It's not gray and it's black and white. It's definite one way. It's definite the other way. There isn't any opinion on it. So you go over that bank loan agreement with them, and it says the word loan. It says the word interest. Interest is for the charge of the use of money, borrowed money. It says the word loan. It doesn't say the word exchange. As soon as you got them charging interest, that means loan. It doesn't say exchange. It doesn't say deposit. It doesn't say that you loan the bank. It doesn't say that they get the promissory note for free. The CPA can take a look at the law and court cases. If you go back, look at those court cases I have in the book, in volume number 2. There's many, many other court cases. They have to understand the court cases, the law, and the agreement. This is part of the audit. If they don't understand that, they don't have the competence to do the audit. The CPA must become familiar with the client's business and the legal requirements and how they affect the financial statements. They almost have to come back and say, well, this is the way we do things. And they have, right on the witness stand. Congress allows us to do this. Well, does Congress allow you to breach agreements? Does Congress allow you to use false and misleading advertising? Does Congress allow you to really make an exchange when you're claiming there was a loan? And you're telling the client it's a loan, but really you're making an exchange and you're concealing the exchange? Does Congress allow you to conceal that in the bank loan agreement, in the advertisement? And they got a problem now. Well, that's the way things are done. Well, if it was really an exchange, then why didn't you put that in the agreement? See, they got a problem here. Well, if there was an exchange of value for value, why are you charging them as if there was a loan? See, they have a problem. Are you telling me then that Congress says that we don't have to uphold the United States Constitution, equal protection under the law, full disclosure under the agreements, and the money system described under the Constitution. Well, they took an oath of office, just like this attorney working for the bank, just like this judge, just like the sheriff and the lawmakers, to uphold the United States Constitution. Isn't that correct? That's what the Constitution states. They got a problem because an oath of office is what? A contract. These people contracted with me to do this. So now we got them under a breach of a different agreement under an oath. So we got to talk about that, Mr. Bank Auditor. No, I don't think this bank auditor wants you to know about these cassette tapes, because once you understand these cassette tapes, man, I tell you, I just thank God that I never did a bank audit. I tell you, oh man, am I glad. I tell you, I'm so thankful to God that I did not do a bank audit. And then you have to come back and did the bank fulfill the agreement? Was there a hidden agreement? Was there something that was concealed in this? Did the CPA follow the Federal Reserve Bank's policies or procedures and regulations? If they did, we know what the bookkeeping entries are. And it's illegal to mislead or omit. So if they say, well, gee, we just follow the Federal Reserve Bank's policies and procedures, is it a policy to conceal information? Is it a policy, you go right through the same thing. To record a loan from the borrower to the bank, or a deposit from the borrower to the bank? Is it their policy that no check was loaned for the bank to legally obtain ownership of that promissory note? See, they got a problem discussing those type of issues. I'm going on. All right, we're going to go ahead and continue on right now. In the audit book, it goes and it talks about material fraudulent transactions. And there's a chapter discussing massive fraud, and describes deliberate management action applying to material misrepresentation, to materially represent the financial statements. Now, this is very, very timely, because just about 2 minutes ago, just before I'm speaking right now, one of my main distributors and I were talking, because I have the call reports on different banks. I got them from an FDIC bank auditor, and that's how I found out about it. So we actually came up with the instructions to fill out that call report, and under the individual schedules, it says Schedule RC-C. It says loans and leasing and financing receivables. That's the place under the asset column of the balance sheet where they record the promissory notes. So they know exactly what they're doing. So you're saying, is this a massive fraud or what? I mean, this is very timely as far as getting this phone call. I knew about I didn't see the instructions before. Okay, so we're going to set that one aside. We're going to go on. So the whole thing is, they know full well. Now, let's say they say they can go ahead and create money. So I'm going to ask them a question. If they say they can go ahead and create money, meaning a bank liability, demand deposit account, because that's what they got to keep on coming back and saying, we gave you a demand deposit account that you can write a check out of. And my question to them is, does that is that checking account balance, does that demand deposit account, which is the same thing as a checking account balance, does that, if there's $100 in that checking account, does that have equal value to legal tender because I can get legal tender for it? Just answer yes or no. The minute they say yes, it has equal value to legal tender, they are going down. You know why? Because where do they get the legal tender? They got it from you, from the promissory note. So you have to earn the money one way or the other. If you earn the money in the past, you earn Federal Reserve notes. And if you deposit Federal Reserve notes, this means money that you've earned in the past. If you deposit A promissory note is the value of your future wages, but you still have to earn the money. The banker didn't earn the money, you did. And you had to earn the money, and you loaned your own money back to yourself, and the banker never worked one day to earn that money to loan to you, to obtain that promissory note. Is this a massive fraud or what? And if you go through the book, you're going to find out if you only had money like Abraham Lincoln, United States notes, there's no checking account balances, no deposit receipts, and everybody had to use cash. If that was the case, they could never get your labor for free. That means that bankers would have to go out and get a real job and produce something of value instead of just take something from you. So if you have somebody who just keeps on taking from you and keep on taking from you and keep on taking from you, you're going to be poor. But if that person keeps on taking from you and lives off, your substance, lives off your payroll checks, and if they were stopped doing that and they had to go out and earn and produce something worthwhile, something of value, they had to manufacture something, they had to grow something, they had to do something like this, you'd be much wealthier. Simple as that. Okay. Now, the audit book goes ahead and it explains that this massive fraud can result in, and it lists about a number of different things. So I'm going to list those now. In fact, I tell you what, we're about out of tape. We're going to have to go to the other side in just a moment. We're going to go to the other side of this cassette tape in just a minute. So on the other side, I'll list those different things. So what I'm trying to say is they have to deny a loan from you to the bank. They have to pretend the demand deposit account has value, and it has no value without the legal tender behind it. That's like writing a check without cash behind it, where you can't get cash for the check. They know nobody will accept a check without cash. All right, at this time, please go to the other side. Thank you. Okay, this is side 2 of tape number 6. And we're going to continue on talking about what a CPA has to do in an audit. And we're talking about there's a whole chapter in the audit book that you could pick up at a college teaching CPAs, or teaching accountants to become CPAs. And it's talking about massive fraud and how management has willfully, knowingly try to misrepresent the financial statements. And they give a list of at least 10 different things. I'm going to read them off to you. And these list of 10 things, it says this can result in 1, intentional failure to record transactions. Number 2, intentional materially misrepresent recorded transaction. Number 3, recording invalid and fraudulent transactions. Number 4, inflating assets. Number 5, failing to record a liability. Number 6, insurance fraud. Number 7, fraudulent transactions. Number 8, audit book describes a company with undue influence and other parties to the transaction. This fits exactly what the bank has done. Number 9, a fraudulent misrepresentation of assets through bookkeeping entries, and number 10, intentional failure to disclose loans. When I'm reading through this right now, it appears to me right now that they have hit every one of those 10 things that meet the massive fraud. Let's go through it again real quick. Intentional failure to record transactions. Number 1, in the audit, the CPA has to take a look at the signatures to make sure that there's authorization, permission, and knowledge to conduct a transaction, a bookkeeping entry. So right here, there was intentional failure to record transactions because it says right there in the Federal Reserve Bank that they exchanged the promissory note for credit and the borrower's transaction account. It just doesn't say this one time. It talks about this a number of times. So it's not a mistake from the Federal Reserve Bank. That's what they meant to say. So if they open up a transaction account, how can they open up a transaction account, not tell anybody about it? A customer comes into the bank, they hand the bank $100,000, the bank deposits it into a transaction account without the borrower's knowledge. How can they even open up a transaction account without the customer's knowledge? And then they credit this transaction account for $100,000, and then they withdraw the money out of it without the customer's knowledge. How can they get the money out of that transaction account by writing a check without the customer's signature on that check? Can't happen. This is a part of intentional failure to record transactions. I mean, you got to have a signature card with a customer's name on it to open up a transaction account. If you're going to deposit something into a transaction account, look under state law, it's going to tell you have to have the dollar amount, the account it was deposited into, and the date. They failed to do that. And then they not only open up this transaction account, but they withdrew the money. They wrote a check out of it without the customer's signature, knowledge, permission to do so. And then what? The bank kept the money. The bank auditor has to know this. He has to know the policies and procedures, and he has to know what the Federal Reserve Bank is saying. If he doesn't, he's not competent to conduct this audit as far as I'm concerned. And I think we ought to tell everybody in the world. Next one, intentional misstatement of recorded transactions. Look, remember the accounting principles? If there's a loan to the bank of the promissory note, there's a new asset called promissory note and a new bank liability. What they do? Intentional misrepresent of the transaction. They refuse to acknowledge that it is a loan from the borrower to the bank. So there's intentional misstatement of a recorded transaction right there. And then number three, the third one is recording invalid or fraudulent transactions. They can't do something without authorization, permission, and knowledge. You know what a theft is? Take a look under theft and stealing. It's unauthorized taking of something. Going beyond permission. They did not have permission to do this from the borrower. He had no knowledge. He couldn't give permission. And then the next one says number 4, inflating assets. They're putting something down as an asset on the bank's books that they never loaned any actual cash value to obtain it, and their agreement was they were going to loan actual cash value to obtain it. That bank liability that they claim they want to loan to you, that demand deposit account, it has no actual cash value. Simple as that. So they failed. Number 5, it says failure to record a liability. That liability, when they have a promissory note as a bank asset and they have a new bank liability, that liability is due to the borrower. They owe the borrower legal tender an amount of $100,000 if they put in that promissory note, $100,000 promissory note as a $100,000 bank asset. They owe $100,000. They never paid it. The proof of it is that liability is still there. It is still outstanding. They only traded that liability from one account to another account. They never paid it. The proof is there because of standard bank bookkeeping entries. The auditor had to know the standard bank bookkeeping entries as part of the audit, so they failed that as far as I'm concerned. The next one, about the insurance. Well, FDIC, if you have to first deposit funds to make that check valid, and that's what the UCC talks about. That's what everybody knows. You first have to deposit something of value to fund that check. Now we're talking FDIC insurance fraud. Next one, this is a fraudulent transaction. You know what a fraudulent conversion is? That's what a fraudulent transaction is. You know, what would happen if I deposit $100 in a checking account and the bank didn't put it in my checking account, but they put it in your checking account and you got to spend it and they refused to give it back to me? That would be a fraudulent transaction. What's the difference between that and a bank loan? I don't know. Next one, number 8, it says the audit book describes a company with undue influence on other parties to the transaction. Undue influence, that's your deception and making people believe something else is really happening when it's not. Number 9, a fraudulent misstatement of assets to bookkeeping entries. That's right. They believe that they own your promissory note without loaning 1 cent of legal tender or other depositors' money. If it's not a theft, It has to be a loan to the bank or a gift to the bank or a deposit. It all amounts to materially the same bookkeeping entry, the same result. Number 10, intentional failure to disclose loans. That's talking about a loan to the bank. They didn't record it as a loan to the bank because they never intended on repaying you. So, in this chapter in the audit book, talking about massive fraud, and they're saying it could result in 10 different things. Man, as far as I'm concerned, it appears to me they hit all 10 things. They should have known this. The bank auditor, if they had the competence, they would have known this, in my belief. And I'm trying to show you as a judge and jury now. I want you to decide, as you being the judge and you being the jury. The next thing in the audit book, it talks about, the audit book explains the motivation of a company to misrepresent or commit a fraud. An auditor has to be aware of this. They just can't walk in and say, nobody ever commits a crime. No, they have to be, they're supposed to protect you, the general public. They're like a policeman. They didn't do their job, did you? You know, how would you feel like the policeman out there knows that Joe murdered Mary, and the policeman knows about it, but the policeman refuses to arrest Joe because, he kind of knows Joe. Well, as far as I'm concerned, Joe is just involved in the fraud right along with Joe. I mean, the policeman's involved in the fraud along with Joe, who committed the crime. Aiding and abetting a criminal act is wrong. Next, it goes on. It talks about management fraud. It shows that they deceived customers, that they deceived the people who are looking at the financial statement, called deceiving users of the financial statement. A user of the financial statement is somebody who is reading or looking at the financial statement. Financial statement, again, is the balance sheet, the income statement, or statement of income. Next, it goes on to uncover the fraud, the management fraud. Number one, you have to know the industry. So they have to know the bookkeeping entries. They have to know about banking, the agreements. They have to know all this. Then they have to take a look at the analytical tests. If they look at the analytical tests, that means the assets and liabilities are increasing. They have to know this. That was part of the audit test. Obviously, they didn't do this. Number three, about management fraud. It talks about review the company's legal obligations and contracts. They have to review that. They have to know the difference between an exchange and a loan. Also, they have to go back to the old auditor and try to attempt to talk to them about and see what's going on about possible fraud. They have to exchange information. So where did they do this? And number five, talking about management fraud, can the company pay their financial obligations? Now listen to this. Can they pay their financial obligations? See, this is the difference where a trick comes in. When you have money in a checking account balance, that's a bank liability. Now, if they want to pay that, what do? You go to the bank teller and you say, I deposited $100 earlier, so I have $100 in my checking account, which is a bank liability. I want the bank to pay this liability, so I want the bank to give me legal tender an amount of $100. If the bank pays their liability and gives you the cash of $100, the bank liability decreases and their assets decrease, and that means they paid their liability. But the trick is this. Instead of using cash, the bank says, well, you can use a check. So instead of paying that bank liability, you write a check for $100, and the liability goes from your account to somebody else's bank account. They still never paid that liability. So when they increased the assets and liabilities when they allegedly granted loans, those liabilities at the bank were not paid. They were only transferred from one person to another, but they were not paid. So here they're talking about paying their financial obligations. They never paid those financial obligations. They never intended to pay those financial obligations, but it sure looked like it was paid because it goes from one checking account to another checking account. A checking account balance is nothing more than a bank IOU. It's like a promissory note from the bank to pay you money. And all the bank is simply doing is saying, If the bank gave you and I promissory notes, we had them in our wallet, and it says, well, the first bank of this city says they're going to pay me $100, and you give that to a merchant. That's how they used to do it. They just, bank gives a promissory note, and you give it to this merchant, and they accepted this money because they know they can go to the bank and get the cash. It's back in Volume 1, the very beginning. I discussed all this back in Volume 1. But now today, they try to be more sophisticated. They want to control you. So instead of giving the merchant a promissory note from the bank, all they do is they tell you that you got a promissory note in your checking account, which is a bank liability. It's a promise to pay you money, and you can't spend it unless you trade it by check. And all a check does is say, well, they no longer owe you the money, they owe someone else the money. Owing money is not paying. So when they say uncover management fraud, in the audit book, it says, did they pay their financial obligations? The answer is no, according to the accounting principles. The bank auditor had to have known that. All right, now it goes on in the audit book. It talks about internal controls. It says, check the accuracy of the accounting data, the bookkeeping entries, and the management policies. Well, the internal controls is the bookkeeping entries. Internal controls is how they do things internally in the company, in the bank, as to how they could even advertise, who does what, who has what responsibility to do what at what desk. And so the auditor has to know what those internal controls are to make sure that the bank is following the bookkeeping entries, to make sure there's a standard way of doing things. There was a standard way of doing things, all right, and I think you could argue it was massive fraud. Now, they might try to come back and say, no, it's not massive fraud. I'd like to have a public trial, a public mock trial, and I welcome the CPA bank auditors, the partners, to testify under penalty of perjury, tape recorded in front of a whole audience, and I want the audience to be the judge and the jury. And it can't be stacked with CPAs and government agents and bankers. It just has to be the ordinary random selection of the population. And I want 100 people out there. And I want this thing to go on for several days to explain all this, let them read the book, let them understand this, and then let the CPAs answer my questions. And I think they got a problem. Let's go on. It talks about inadequate internal control exists when? Number 1, it says sales are made and not recorded. Number 2, loans made but not recorded. Receiving assets but not recording who you received it from or the company ever paid for it. Now, this is exactly an inadequate internal control. They received an asset from the borrower, but they never acknowledged it. They just kept it. And so he talked about the fact when an alleged borrower signs a promissory note, his only belief is that I'm going to repay the money that they're going to loan to me. But see, the bank adds something to this, and they say, we're not going to loan you any money. We're going to first record this as a loan from you to the bank and then loan it back to you, which creates new money, which transfers wealth from the borrower to the bank in the amount of $100,000 of future payroll checks. So it's like stealing and counterfeiting combined. No one is that stupid to say, yes, I agree to have the economic effect of someone stealing $100,000 from me and counterfeiting $100,000. Now you ask your neighbor if they're that stupid. They're going to say, no, they're not that dumb. But see, the bank auditor obviously believes that people are that stupid. But yeah, if you go to your neighbor and say, well, I'm going to explain what's really going on. Did you ever willingly, knowingly agree to this? And they go, no, I never agreed to that. But the bank auditor thinks you agreed to it. But see, the bank auditor, if I go to the bank auditor and say, tell you what, if you think that's such a great deal to the average person, I tell you what, let me steal $100,000 from you and I'll return it back to you as a loan. And they'll say, no, I don't want to do that. That's not a good deal. So you turn it right around in their face. Now, why would a bank auditor, a CPA auditor, care if the company's being audited received assets for free without fulfilling an agreement? See, this indicates a possible illegal operation like cattle rustling or stealing or a Ponzi shop or something like this, where somebody goes out and steals, and goes and sells the materials later. If they're involved in a fraud like that, the CPA has to note that in the audit report. Obviously, they did not do that. Now here it says how is this detected? The auditor sees that the company bought $5,000 of inventory, new assets. In this case, it would be a promissory note. And the auditor looks for the free $5,000 worth of canceled checks. So if you bought $5,000 worth of something, the auditor has to see if there's $5,000 worth of canceled checks to make sure that they paid. But in the case of a bank audit, they can see a canceled check, but they got to see what customer brought the funds to fund the check, and that was the borrower, not other borrowers. Just a few minutes ago, somebody called me up, and they legally tape recorded. They were doing some detective work, and they called up the credit card company, and they just asked them. I said, I just want to ask some questions. Where do you get the money anyway to lend on his credit cards? You get it from other depositors, or where do you get it from? And the guy says, he says, everybody at the credit card place, he goes, hey guys, stop. I got a question. And the supervisors came back and says, well, we get it from other depositors and other investors. See, that's a lie. And we got it now on tape recorded. We know who said what, the telephone number it was called, the date, time, and everything else. These are false statements of the management, lying to you and I, trying to deceive you and I. Now, if they really told us the truth, we would be outraged all across the nation. So this is what we're talking about. Now, let's apply this to a bank loan agreement. On our $10,000 loan, there's a $10,000 worth of canceled checks. No problem. Now, was there a fraudulent concealment and fraudulent conversion as to who provided the capital for the check? Was there a breach of an agreement? Who funds the transaction that was to fund the bank loan check? Was it the borrower or the bank? That's where the CPA has a major problem, especially when we do this type of tape recording and detective work. And you could do the same thing. But see, that's why we're trying to raise money and capital so we can pay for things like this, we can get these type of things done. And that's why we really, really appreciate it when you are, selling books, because that helps fund us, and it's going to help you so we can help you later on. And again, this cassette tape is copyrighted. It's a trade secret. You cannot let anybody else listen to it. That's the agreement. If anybody else does, it's a felony because it's a violation of trade secrets, Tom Schaaf's trade secrets. And there's a penalty for that. And if anybody gets caught doing it, they're out of the club. And we don't put everything in here because there's certain things you're going to need to go back to the club leader to get the rest of the information. That prevents people from being able to do everything on their own. Because it's just like shoplifting. All right, let's go on. Now they have a number of different problems right here. Problem number one, what did the agreement or advertisement make the borrower believe? Number two, how can the borrower fund the check if the borrower had no knowledge of the deposit, withdrawal, or the funds without the borrower's signature? Number three, the interest is for the charge of use of borrowed money. Assets and liabilities increased. The CPA is there to protect the public. They didn't know this. The CPA had to have the competence to know what was going on. Obviously, there was a breakdown right there. The CPA must know the Federal Reserve Bank policies and procedures. The CPA must know what the agreement says. The CPA must know the bookkeeping entries. The agreement plus the bookkeeping entries are really the opposite, which change the cost and change the risk. There's supposed to be a segregation of duties. This means the internal control is best when employees at the bank have authorization to purchase something or to lend something out and have have authorization for the bookkeeping transactions. Obviously, it did not come from the borrower from whom they received the funds from. So what, in a regular business, you want to have internal control where there's segregation of duties. Now, when I was a controller and treasurer for a major manufacturing concern downtown Chicago, I mean, it wasn't downtown, it was very close to downtown. And it was in walking distance, easy. And it was along the river because there was barges and things like this. It was a heavy manufacturing. We had our own power plant. Well, I was able to sign off on checks, and I was also the guy who did all the bookkeeping entries. And see, if nobody were to watch me, I could steal plenty of money right out of the company, and very few people would ever figure out how to do it. So not only I had to sign the check, but a second person had to sign the check, like my boss or the person that the person directly below me. You know, the lady that had a desk right outside my office. Or there was there was one other guy that also, signed with me. And when I got the job, I asked him, I said, well, why do you want me? Well, they wanted me because, number one, they knew that I had an art to turning companies around and making them very, very profitable. Because when you're a business broker, you walk into a large company, you have to know how to get that company turned around. Also, they knew I was honest. They did some checking around. I would not take on an expert witnessing case if I didn't believe that I was going to give the right value. I had people come to me that would pay me large sums of money if I were to lie in court and come up with a different value when that company was really worth. And I turned it down. I said, no, I'm not going to do it. And I had a reputation for honesty. In fact, one time I was actually on the witness stand. Oh man, I got to tell you the story. I don't know for sure what I've said back here. Let me just finish this and then I'll tell you. But anyway, they knew I was honest, so they weren't really concerned if I was involved in the bookkeeping entries and also signing off on the checks. But they still had to have someone else sign off on the checks to make sure I wasn't going to steal anything. And that's part of internal control. So different people are watching different individuals. So not one person can do all duties and defraud someone and get away with it. Okay, since I'm on this, I just mentioned this. Wait, I got a couple others, and then I'm going to talk about it. Okay, this goes on. It says, next thing is the CPA will examine the checks to see if the company paid for an item such as a promissory note. The problem is whose account funded it or was it withdrawn from. And next thing was the promissory note deposited? Now, if it was not deposited, then they're saying they do not deposit money to issue a check. So then the next question is it check kiting? Now, if they don't deposit the promissory note, do they sell it before they own it? Sell it, get the proceeds, deposit that, withdraw the money, and then keep it? They don't have many choices in this as far as discussion, as far as I see it, because I can go back to the Federal Reserve Bank publications and they say that they loan depositors money. So was there a deposit slip? Did it show the amount and date and the account number? And take a look at state law, I think you're going to find that. Take a look at Federal Reserve Bank publications. If they're not loaning depositors money, then where'd the money come from? Number 11, did the bank bookkeeping entries reflect an exchange, value for value, and they charged you as if there was loan, or did they loan actual cash value first to obtain your promissory note? Next one. You're going to read my second book, volume number 2, and it talks about on the bookkeeping entries, a new asset, new liability. The banker has to divorce those assets and liabilities and say just the liability is the money and the gold coin or the cash is no longer the money. We know the new asset and liability represent the exact same transaction, so therefore they gave us back exactly what we gave them. Actual cash value, there wasn't any loan, it was an exchange. Next thing, a CPA must confirm the accounts receivable. That means that you're going to stay. The CPA is going to The CPA is going to say that people are making the loan payments, so that confirms the accounts, the promissory notes. No, I say they may very well be extortion payments, and there was a fraud because they didn't realize they're being loaned their own money instead of someone else's money. The best kept secret is one that has not been detected yet. To confirm accounts receivable can destroy this, and the confirmation would be like this. The CPA would write to the borrower and ask, how much money do you owe? And you would write back, and then you can argue with them. I've never seen this happen yet, where they've done the confirmation like this. One credit card company said that they were receiving 30 letters a day, people saying there's a fraudulent transaction. Obviously, they're not telling the CPA about this. Number 15, transactions must be properly authorized. Again, I think we have a problem here as far as the audit. When did you authorize them to record the promissory note as an asset with a new bank liability? Or were you to be the depositor, creditor, or lender to the bank? Where was this authorization? Number 16, as far as problems the auditor has. Transactions are to show the proper classification, the account classification as far as journal entries. So if they're going to record the promissory note as an asset, they should create a liability saying they owe you the money and tell you that they owe you the money. They didn't do that. Okay, now I want to go back to what I was going to talk about earlier, about honesty. I believe in really preparing ahead of time because people knew I was honest. One of my guys wanted me to be his expert witness, and I found out the guy was lying. He was committing a big fat fraud. I wouldn't let him get away with it. He said, "You're no longer my expert." He wouldn't hire me any longer. Well, that's fine, but I'm going to tell the truth, one way or the other. I remember one time I was in depositions the whole week. The other expert was in depositions the whole week, and the whole courthouse. Everybody there was watching this. They were reading the depositions, which is really unusual. Even the judge read all these depositions, which is really highly unusual. Usually a deposition is there to find the weak strengths and weaknesses of both sides so you know what to say or not say in court. This professor gets up on the witness stand to give a business valuation. I had drilled and worked with my attorney for about 2 full days, explained to her what to say, what not to say, how to say it, and she would put it in her own words, and she would say it all the wrong way. You'd lose the whole court case just by saying the wrong words. Well, finally she understood what to do. She got up there, and she just ripped the living daylights out of this guy, and the court recorder was still going. And the judge says to this lady attorney that I was working with, he says, "You just utterly destroyed this expert witness." And the court recorder was still going. My turn was to get up. And I wanted to give a 2 or 3 hour spiel. And as soon as I started talking, the judge says, "I don't want to hear it. You don't want to hear anything I had to say." I said, "What in the world is going on?" He said, "I just want to know what the value is." No, and then he says, "Well, I want to know what the normal capitalization rate is of a normal business." And I told him. He says, "Yeah, I know that's right, because I did some checking around." He says, "I know you're honest." He says, "Now, tell me what the value is." And he didn't care what I had to say. He just wanted to know. And the other side lost because of honesty. You want honesty. You want an expert witness up there. That is why I'm trying to show you how to utterly destroy the other side. When I was evaluating and appraising businesses, I had a mobile phone in my car. Those are the old days when you had those great big, like almost suitcases you had to carry around with you. Like a great big bag. It weighed about 10, 15 pounds. And I had it in my car. I had a Cougar at the time. And there was a thunderstorm, great big thunderstorm. It was just, lightning and just, goes boom right overhead and just boom. And there was an attorney trying to call me. And he says, "Tom, we got a problem." I never met this attorney. I didn't know who he was. And he calls me up and he says, "Tom, He says, the judge, you know there's a 90-day rule. You have to tell the court 90 days in advance about the expert witness and who they are, so the other side can go ahead and depose them and all this. He says, you know about that, but the judge allowed an expert witness to come at the last minute for the other side. I have to have an expert, and I'm here in court, and I don't know what to do. And I said, well, I'll charge you extra, but I'll do it. It'll take a couple days. So the very next, as I was talking to him, the lightning was going off and got disconnected on the mobile phone. He had to call me back. This happened like 3 or 4 times. The next day I was there. I valued and praised this business very, very fast. If you've been a business broker, you know real quick what something's going to sell for. And the next day I was in court. Now, the thing is, and I'm telling you this story because you need to know this if you're going to teach someone to be an expert witness. This attorney that I'm working for did not know me. He didn't know if he could trust me. He has to trust you. When you're working with an attorney, they got to trust you. There's a case right now against a bank, and we kept on telling that attorney exactly everything was going to happen 3 or 4 steps ahead of time, what the bank was going to do. Finally, this attorney comes back and he says, you know what, you guys must know what you're talking about. Every time you tell me something's going to happen, 2 3 weeks in advance, it happens exactly like you guys said. You guys must know what's going on. So this attorney now, for this banking thing, he's starting to trust us now because he knows that we know what we're talking about. So let's go back now to the lightning and thunder and the business valuation. So here I am sitting next to this attorney in court because I'm the expert. I can sit next to the attorney. The other side puts up this expert witness that they got at the last minute up on the witness stand. Here I am saying to my attorney, ask him this question, ask him this question. I had to write it out, and the attorney gets to ask the question. It really got to the point my attorney was saying, why are we asking these questions? I said, just look, this is a specialized field. I know about business valuation. Just do what I ask. Trust me. An hour and a half after asking these questions, this expert from the other side on the witness stand bolts up, stands up, and he says, I quit. I'm no longer the expert. And he gets up and walks out the door. I'm the only expert left. Okay? We won. So, they had about a 20% chance of destroying their career if they wanted to go against me because I had a set of questions to ask the expert on the other side in business valuation, no matter what type of method they were going to pick. And I knew how to utterly crush them. And I taught that all over the country except where I lived. By agreement, I didn't want to teach that where I lived. I figured someday someone might try it against me, so maybe I had to switch fields. And my parents were really happy because they didn't want me keep on working all this divorce and then not wanting to get married. So you have to have honesty. If you're going to have an expert witness, they got to get to know that attorney. One of the toughest times I ever testified was I didn't know my attorney. I couldn't trust him if I was on the witness stand. I didn't think he was going to come back and, cross, redirect and all this, and I was afraid I wasn't going to get my information out. I was afraid I wasn't going to be able to say what I wanted to say on the witness stand, and it was hard. It was really, really difficult. So the expert and the attorney must get to know each other, know what to expect out of each other. They should go over these things and whatever. Okay, I'm going to continue on now with audit tests. There's a test of overall reasonableness. Now this is where you're going to nail them, and it's the ratios and the trends. So their mistake is, if they compare the bank ratios over the last couple of years in the industry, the assets and liabilities keep on going up. So where do they get this extra money? And the promissory note is recorded as a bank asset, so it sticks out like a sore thumb. They're supposed to know this. Why have bank auditors come back to me, CPAs and FDIC, and tell me they know it's a fraud? Because they understand this. And the other guys that say there's no fraud, then they better answer all my questions, because they're just they don't want to go to jail or don't want to get sued or whatever. Number 2, compliance test. Has to do with flow charts, internal control, questionnaires, and a standard Federal Reserve Bank publications and their bookkeeping entries. The third thing in an audit test is substantive test. And the test, the individual dollar errors. The auditor must decide if the errors are material. Well, to me, I think they are. Then there's a type of test here, analytical, observation, and test of transactions. Let's take a look at the test of transactions. That's where you need to read the loan agreement and then examine the bookkeeping entries. And then there's a test of account inputs and outputs. And in other words, what causes the account balance to increase or decrease? Remember the assets and liabilities increased? The key is transactions are creating an account balance, and they're verified by supporting documents, and this procedure is called an account analysis. So in other words, if there's a new asset on the bank books, I want to see the documentation that allows it the authorization, permission, and knowledge, okay? I used to do these account analyses right out of college. Let's take a look at the test of transactions. Is it an invalid transaction, a withdrawal or deposit? See, a lot of times banks says, well, gee, if we're going to withdraw money, I want to see that authorization. They should equally say, what's the authorization to deposit something, record something as an asset? Where's the authorization? Because, see, otherwise it could have been a theft, and the bank stole it and recorded it as a bank asset, and they have to look at these things. So if there's an asset, there's new liability. That liability means a loan to the bank. And they're supposed to look at these loans, look at these deposits. Number 2, are transactions properly authorized? If you deposit a payroll check, there's a deposit slip. If you write a check, you sign a check. The nightmare of the bank auditor is the borrower had no authorization, permission, or knowledge of an exchange or deposit of the note to fund the check. Next one, number 3, existing transactions are recorded. So you take a look at the existing transaction, and then you go back, and then you take a look for the authorization. So one place, you look at the agreement and go back and look at the bookkeeping entries. Another test is you take a look at the bookkeeping entries, then you go back to the agreement. So it's a way to catch things both ways. And then you want to know if something was properly valued. Well, they record a $100,000 promissory note as a $100,000 asset. So they're saying it does have value. By them recording the promissory note as a bank asset, they're saying it has actual cash value. So they took something from you that had actual cash value, but they loaned no actual cash value to obtain it. That's what the proof of the audit is going to prove. The audit will prove this. The bookkeeping entries prove this. The accounting principles prove this. Then you want to know if the transaction was properly classified. It looks like a hidden type of transaction. Now we're going to talk about direct tests to determine the financial balances. Direct tests could be overall reasonableness. If you spend money, the bank assets and liabilities decrease. If you deposit money, bank assets and liabilities increase. That's overall reasonableness. It's pretty general. And in this case, if there's a bank loan, do assets increase or decrease? If they loaned other depositors money, assets and liabilities decrease. If they received something from the borrower, assets and liabilities increase. They have to have known this if they were competent in conducting the audit. Next thing is mechanical accuracy. That's like adding up on a adding machine. Next thing is ownership. And the audit book explains that the asset must be owned before you can add the asset to the financial statements. That's the balance sheet. In other words, you can't add your neighbor's car to the company's balance sheet because the company doesn't own your neighbor's car. They didn't pay for it. So you go back and you take a look at this, look at ownership. What did that bank loan agreement imply? There was no verbal agreements. That's what it says. There's no written. It's only what's in writing counts. And they're calling. They loaned you something. If you were to sign this promissory note, they knew they weren't going to loan you any actual cash value, which makes it promissory fraud. And that's what I believe. So you're going to nail them on the ownership issue. Remember before I took quite a bit of time and I said, if you're at a seminar and you have a promissory note and you sign it, say I agree to repay the $100,000, and you clench it with your hands right in front of the mock trial, the people, the jurors or the people attending the seminar, and you say to them, what does the bank have to do before the ownership of this promissory note transfers from the borrower to the bank? What do they have to do? They have to what? They have to first what? And they all say, give you a $100,000 check first before you give them the promissory note. See, the bank auditor is going to have to argue that once you sign the promissory note, they don't have to loan you 1 cent of any actual cash value, and they now own that promissory note, and you have to repay. That doesn't make any sense, does it? Let them try to argue that in front of a bunch of jurors. This is why I'm trying to get you to argue things in a certain way, so it's going to be very difficult for them to come back. So the question is, did you agree to be the lender or depositor? No. Did you agree to give up the right to withdraw that deposit as your own capital and the bank return it back to you as a loan? The bank auditor must know the answer to these questions in order to discuss this ownership. If they don't, then they don't have the competence to have done the bank audit. That's why I like going after the CPA auditor. Now, if I've been wrong, they should have come back and sued me a long time ago. They can't. They cannot discuss these issues. So I want to know about that written agreement. The minute they say this is the way it is, you hand that written agreement to them right on the witness stand, and you say, well, you show me where it agrees to this in writing. It says here there's no other verbal agreement, so only what's in writing here counts. And it says money, has a dollar sign. It says money. Is money legal tender? Yes. The minute they say yes to that, then they cannot claim a demand deposit account is money too, unless they're saying demand deposit account has equal value to legal tender, which means there has been an asset offsetting that liability, and the asset and the liability are directly connected to each other. They're married and cannot be separated. So therefore, if that's the case, the banks cannot create new money without having the promissory note be the thing to give it the value. Now, some people might want to attach the CPA's name to the bank when you go to sue them. And then you would subpoena the CPA in their permanent file. The permanent file shows the internal, that's part of the audit, the permanent file, the internal control, the analytical tests, the contracts, etc. So if you're going to subpoena that bank auditor CPA, you're going to ask for the work papers and permanent file of that audit. All right, this reminds me of a story. I was talking to a CPA partner who does the bank audits, and he was auditing these mortgage companies, these brokers, and he admitted that they don't loan their own money. What they really do is they work like a department of the bank, like a lending department of the bank. I also talked with the vice president, one of the biggest loan brokers in the country, and he admitted exactly the same thing. They don't use their own money. They really take the promissory note to the bank, and they use that to fund the check. So it goes right back to the exact same things we've been talking about all this time. All right, we're going to have to go on to the next cassette tape, and we still got a lot more to go. All right, so Guys, I just really appreciate you. You know, the faster I can teach you and find out who's really loyal to the cause, I want to be able to come and put on a seminar for the general people in your area, and then I want to put on a more sophisticated seminar for you guys who have bought this course. Because then I can even teach you more things, try to answer more questions. So I ask you to invite me to your place for me to do a seminar, okay? Just get a hold of me and write to me or whatever. Thanks. Let's go on to the next cassette tape.